not been losing ground. The miners have held their ground since 2015 on a percentage basis. They've gone up about as much as gold, if a little more. But they'll accelerate to the upside at some point. And that point will be especially when people in the stock market say, hey, I got to get out of this thing. I need to buy some other kind of stocks. They're not going to go out and buy gold, silver futures and use leverage, and they're probably not going to use double long ETFs of bullion. They're going to go for the gold miners and silver miners. But they'll go into a leadership position, and I think that's probably going to be the best place to be on the planet is in gold and silver miners in 2025.
A year ago, even $2,500 seemed impossibly high, yet today that feels low. Gold's fantastic 27.2% gains in 2024 accrued despite bearish headwinds. During that remarkable year, gold powered higher through bouts of extreme overboughtness, exceedingly overextended spec gold futures positioning, and American stock investors ignoring it. As gold soared 27.2% last year, the leading GDX major gold stock ETF clocked in at merely 9.4% gains. That made for a terrible 0.3x leverage to gold compared to GDX's historical range running between 2x to 3x. Because gold stocks heap big additional operational, geological, and geopolitical risks on top of gold prices, they have always way outperformed their underlying metal to compensate traders for those added risks. Highly regarded financial analyst MichaelOliver emphasizes the undervaluation of gold and silver miners, noting their outperformance of the S&P 500 since 2015 despite little recognition. He foresees stock market pressure will drive funds into this small sector, leading to significant gains. A major paradigm shift in gold stock revaluation in 2025 will require big capital inflows, meaning traders will have to grow interested in this sector. Miners are bouncing from their December low, and the key level to watch is $37.30. Progressive closes above that level would promote more upside, whereas failing to recapture that level in January would open the door to more consolidation. In his assessment, Oliver mentions gold's return to all-time highs against the Bloomberg Commodity Index after underperforming from 2022 to 2024. In 2024, stocks have more than doubled their average return, yet gold and silver handily outperform the stock market benchmark S&P 500 index. Through the end of the third quarter, GLD had risen 27%, SLV was up 30% for the year, while the stock market, measured by the SPDR, S&P 500 Trust ETF, was up nearly 22%. Now, we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Over the last 25 years, we showed a chart going back to 2000 where Bloomberg Commodity Index and the gold were measured against each other. And gold is now back at its all-time highs of the last 25 years. There was a period there when gold had doubled in price between its 2015 low and the mid-2020, summer of 2020 high, went from 1,050 to 2,070, almost doubled. During that same time, Bloomberg Commodity Index was still going down. Commodities were not following gold. And then when gold paused for a couple of years there, it frustrated everyone, went into a range that was at max 20% wide, but most of it was about 15% wide. Bloomberg exploded. So the Bloomberg versus gold spread collapsed versus gold. So gold underperformed during that period from about 2022 to early 2024. Now has exploded back up again, back to its all-time highs. But it's our technical assessment and fundamental assessment that the commodity complex will be a place that exiting money from the stock market will be going. And I don't mean going into corn futures and oil futures, but into stocks related to those commodity markets, like oil-related stocks, base metal-related stocks, agricultural-related stocks like fertilizer and so forth. There will be a place to go. So if you're looking for an alternative place within the stock market, I would be looking at commodity-related sectors. And particularly, I think ag sectors, agricultural-related, would be a best place. And then there's the issue of the gold miners, gold and silver miners. If you go back, we ran a chart a few weeks ago showing the XAU index, which is the Philadelphia Gold and Silver Miners Index. It says miners. And it traces back to 1986, that index. So it's also not an ETF. It's not traded as such, like GDX is. But if you measure that index from its bare low in 2015, coincident with when gold made its low, it's gone up like 120%. At current price levels. It's actually, since the S&P, it beats the S&P, but nobody notices this, marginally. And yet it's hard to believe that, but you can actually measure it. But when you look at the long-term charts of the gold mining sector, the price charts, but especially when you look at its valuation versus gold, the miners, how cheap are they versus an ounce of gold, or how expensive are they? Right now they're on the floor, okay? And they've been there since 2015. Not been losing ground. The miners have held their ground since 2015 on a percentage basis. They've gone up about as much as gold, if a little more. But they'll accelerate to the upside at some point. And that point will be, especially when people in the stock market say, hey, I got to get out of this thing. I need to buy some other kind of stocks. You know, they're not going to go out and buy gold, silver futures and use leverage, and they're probably not going to use double long ETFs of bullion. They're going to go for the gold miners and silver miners. And since that's such a tiny little sector, and it's so undervalued, not only in relation to gold, but in relation to the S&P, it won't take much money flow, the blood flowing out of the stock market into some other category to boost the gold miners off the page, because they're such a tiny little asset category. And we expect to see that in 2025, where suddenly the perception that miners are dogs that, lag gold all the time, and they don't. Sometimes they actually lead. People overlook that. But they'll go into a leadership position, and I think that's probably going to be the best place to be on the planet, is in gold and silver miners in 2025.
In his interview, MichaelOliver criticizes 15 years of Federal Reserve policies, citing low interest rates and excess money supply as causes of economic distortions. Oliver expects gold to benefit significantly as funds exit collapsing markets. According to him, the key beneficiary of this crisis will be monetary metals like gold, which he predicts will experience a significant surge as funds flow out of collapsing stock markets into safer assets. Gold has outperformed the total commodity index by 61%, the energy commodity index by 66%, and the food commodity index by 58%. Precious metals rarely outperform stocks, significantly when stocks are outperforming themselves. For example, in the long term, it's reasonable to expect precious metals to perform near the inflation rate, which has historically been a bit higher than 3% per year, while stocks have averaged around 10%. Let's get back to the interview.
We've had what we call, people like to talk about prior stock market bubbles. The 2007 high was a bubble, it was mortgage defaults and all that stuff. And then 2000 high was the dot-com bubble. And in 1929, of course, everybody thinks that was a bubble, and we collapsed to 1932, wiped the thing off the page almost, percent-wise. It took decades to get back to it. So those are things people call bubbles. But this bull market bubble that we've had since the 2009 low has been created by factors that are so bleeding obvious that when you go to the Federal Reserve of St. Louis and click through some charts, and I suggest looking at M2, for example, the money supply, and looking especially at the Fed funds rate chart, you'll see that we've had interest rates by the Fed, the short end of the market, near zero for 15 out of the last 15 years. About 10 of those 15 years we were at zero. Money was free. And even when they raised it recently, and now it's starting to back off again, even those levels are historically very low levels. If you go back 50 years on that M2 chart, you'll see, even though they raised rates recently, they're still very, very artificially low cost of money. When you have that sort of embedded error, fundamental macroeconomic error being the pricing of money, most essential commodity in any transaction throughout the world or domestically. And if it's changing in value because of the quantity of money increasing drastically, in the last 15 years, we've had more money growth than we've had in any other 15-year period, percent-wise. And then we've had artificially low rates. So that creates errors, and they're protracted over a very long period of time. We're not talking about a 2-3 year bull market that's busting. We're talking about a 15-year bull market that went up like 5 times more percent-wise than any prior bull market. And you can say, whoa, it's a good, strong economy. Yeah, right. It's due to look at the M2 chart. We've been drug infused with M2 money growth and with free money, effectively, for so many years that it's as if we've been administered hallucinogens by the central bank. And so when those errors start to get ripped open and exposed to the wound, and you start to hemorrhage, then it's beyond the control of the central bank at that point to then sort of, oh, we made a mistake. Let's go back and fix it. They always try to. You go back and look at the 2000 dot-com top. They started cutting rates in early 2001 dramatically. All the way down, the market collapsed. NASDAQ went down 82%. Rate cuts didn't save it. 2007 mortgage peak, we collapsed 50%. In S&P, they cut rates all the way down. It didn't stop it from collapsing. So this time around, even though they're going to cut rates, they've already started, Once the stock market peaks, that's historically when you see the data points, the things like they like to talk about. What's unemployment look like? It's factory output. All those metrics that the Fed likes to look at will suddenly go dark. Not before the market breaks, but after it breaks. That's when it occurs. And at that point, the central bank, not just ours, but others, will go into panic mode in unison. They work together. And that will create monetary expansion globally, not just here, and desperation and moves by central banks to buoy their assets. The beneficiary of that's going to be primarily the monetary metals. And that's the place to be, especially this coming year. And we've been waiting at MSA for the breakage of the stock market as a key factor in causing the monetary metals to go into the more berserk mode on the upside. Because once that blood starts to come out of that market, it goes somewhere else. Anytime the stock market collapses, the asset flow doesn't disappear. It actually seeks other places. Usually that's T-bonds and gold. This time around, it's going to be primarily gold and related markets. And it's the breakage of the stock market that is the key pending impetus for gold.
Gold outperformed the S&P 500, and silver came close, which was even more surprising than crypto prices for the year. Similarly, miners are pushing themselves towards new highs, making this sector even more attractive. Could the economic shift and rising interest in gold and silver mining stocks redefine market priorities in 2025? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.